Hello guys and welcome again to my channel. So this is a continuation of our mastery for journal entries. Okay, so actually there are two types that we have to master: the journal entries and the adjusting journal entries. So for now, let's have both the journal entries again for selected transactions and the adjusting journal entries. Why is it I am focusing too much in this adjusting journal entries and journal entries? It is because for me, when we talk about fundamentals of accounting or the foundations of accounting, this is the most important. Okay? So if you will not be able to master the journal entries and adjusting journal entries, you should forget already mastering the other topics. Okay? Now, especially on the higher accounting, if you don't have this particular mastery of these foundations, these basics, then you'll not be able to understand the higher accounting. And in the basic accounting subject or fundamentals of accounting subject, you'll not be able to go to the next steps. Okay? Because if you are wrong here, then you are already wrong in the next steps. Okay? And plus, on the next steps, if ever you master this, the procedures in the next steps are just, what do we call this? Procedural in nature. Okay? You just have to follow a procedure. Here, you need analysis. Okay? Now, these are some transactions related to BBG company that we have been talking about in the past episodes. Okay? You will understand why I selected these transactions. So, what's my purpose here? It's on the adjusting journal entries. But before we go to these transactions and to adjusting journal entries, let me remind you again of two things. The first one is that uh, we have the accrual concept, in which the accrual concept states revenues are recognized when earned, regardless of when collected. Simply stated, you're going to recognize revenues when you already earned it. So, what's the earning process? If ever you have already delivered your services or goods, that means the revenues are already earned. Okay? Now, regardless of when collected. So, meaning if the customer will not pay you yet, however, you have already done your part, you have already given the services, you have already given the goods, then you have to recognize revenues according to the accrual concept. And there are two parts of the accrual concept, and the part 2 talks about the expenses. Expenses are recognized when incurred. That means you have already enjoyed the benefits for those expenses. Okay? Otherwise, it will not be considered as expenses if you did not yet consume the benefits. For example, again, if you pay for water bill, if you pay for electricity bill, so that particular example or transaction is an expense because you have already paid for those things that you have already consumed. Okay? So that's the meaning of this incurred. So we have regardless of when paid. Okay? So that is the accrual concept. That's number one before we go to the adjusting journal entries. Okay? Number two, you have to remember always the rules on debit and credit. Again, assets equals liabilities plus capital. That's the accounting equation. And that, instead of saying the assets is increased, you'll say that it was debited. And of course, if the assets will decrease, you're going to say it is credited. And on the liabilities and the capital, it's the opposite of the asset. So meaning, if you incur liabilities, you have credited. If the capital is increased, you have to say credited instead of saying that these liabilities and capital increased. Of course, if ever they are going to decrease, you have debited here in the liabilities. Also in the capital, you have debited. And on the capital, the transactions that normally credits the capital or increases the capital are the investment from owners and revenues. Now, if the revenues and expenses are summarized, then what will be credited in the capital is the net income. Again ha, if the revenues and expenses are netted together and it resulted to a net income because the revenues are greater, then what will be credited in the capital is the net income. But if it is not, if the revenues are still separated with the expenses, then we have revenues. And those that will debit the capital account are first, the withdrawal of owners. And expenses. But then again, if the revenues and the expenses are summarized and that the expenses prevailed, the expenses are greater than the revenues, then what will happen is that what will be debited in the capital is the net loss. So those are the two things that I wanted to review first before going through the adjusting journal entries. Okay? Now, let's go to adjusting journal entries. As you can see, I have here letter C and number 1, letter D and number 2. Because actually in our original problem, we have two sets of transactions. We have the letters, those transactions that are labeled with letters from A to J, if I'm not mistaken, or A to I, if I'm not mistaken. And we have also 4 adjustments, 1 to 6. So this time, I paired them. Okay? So, what's the point? So, let's go to letter C first. So, letter C is that there is a rent payment for 5 months, 3,000 per month. It was paid in advance at the beginning of November. And if you can remember, we are following, the BBG company is following the year end at December 31. So meaning at the beginning of November, there are 2 months until December 31. Right? So at letter C, again, there is an advance rent of 3,000 per month for 5 months that was paid by the company. Okay? Now, because of this accrual concept, I told you that your analysis for letter C, if we have A is equal to L plus C, is that first, you have to recognize a credit cash or a decrease in cash, which is 15,000. Credit cash. So this is the symbol for deduction in cash because you have paid for rent in advance. So credit 15,000 cash. And I told you that since this payment of cash is not yet an expense, it is because you have not yet incurred the benefit for the rent in advance. Then we have to have another asset, which is the what do we call as the prepaid rent. Okay? So, basically, there is just an exchange of assets. Okay? So that's letter C. However, let me emphasize again that this prepaid rent is just a temporary asset. Why? Because as time passes by, that will become expense bit by bit. Like for example, after 1 month, of course, 3,000 will become expense. You follow? And then, Since we have number 1 here, it's very clear that the rent for 2 months has expired. So meaning, portion of this prepaid rent should already be expensed. That's what I told you. Okay? So, what will happen on the effects on the A is equal to L plus C? Of course, since that is 2 months, 3,000 times 2 months, 6,000 will be deducted. So, again, the deduction is from prepaid rent, leaving a balance of 15,000 minus 6,000, we have 9,000 still, the unconsumed or unexpired. And I told you, the pair of that is here, 6,000, and then this is what we call as rent expense. Okay? So, actually guys, these are two types of transactions. Okay? So, the first one is the original transaction. Let's call this original transaction. This letter C, the advance payment. And this one is the adjustment. This always happens if you make an advance payment. So again, this is the original entry. And the second one, this one, is the adjustment. Now, let's make the original entry, the original transaction entry. It's just debit prepaid rent, because again, the asset, if it is increased, it should be debited prepaid rent. How much? It's 15,000. And then credit cash, 15,000. Okay? And as to the adjustment, so this is the original entry, and this happened on the beginning of November, so 11/1. So, as to the adjusting entry, I told you that on 12/31, there will be an adjusting entry, this one, because 2 months has already expired. So, what will happen is, since rent expense deducts the capital, that means its normal balance is debit, so debit rent expense. Okay? Again, expenses are debits. So rent expense, 6,000. And then we have prepaid rent, which is also 6,000. So in summary, at 12/31, the unexpired is first on November 1, it's 15,000. The unexpired prepaid rent. Okay? However, at the end of the year, there is an expired portion of 6,000, which is this one. Okay? So the unearned remaining, the unexpired portion at the end is 9,000. So that's the full analysis and the entries. Okay? Now, here's what I have not told you about. Actually, this type of recognizing advance payments. So advance payments are actually first, they are considered as deferrals. And there are two types of deferrals. So this one is what we call as deferred expense. So from the name itself, deferred expense, it should be an expense already. However, since the benefit has not yet been incurred, so according to accrual concept, expenses are only recognized when incurred, regardless of when paid. So it has not been used, it has not been incurred, because this is an advance payment. So it will be treated as deferred expense. So it's not yet an expense, it is still an asset. If you can see deferred expense, that's an asset. Supposedly, it will become an expense, but since it is still deferred, it's still in the assets. Okay? So, deferred expense. Now, again, here's what I did not tell you about in the past episodes. So, this type of entries for deferred expenses like prepaid rent, is what do we call as asset method. So this whole here, that is asset method. Why? Because your advance payment of 15,000 was recognized first as an asset, which is true. That is still an asset because you have not yet incurred the benefit. Again, that is correct. Do you follow? However, this type of making entries is tedious. So, there is what do we call another type of recording in which on 11.1, instead of recognizing it as prepaid rent, you're going to put that immediately as rent expense, even if you did not yet use the space yet that you have rented. Okay? So, it's immediately rent expense. And then, credit, cash immediately. Okay? So, as if in 11.1, everything was already utilized. You have already incurred the full 15,000, which is not true, right? However, it will make sense later. And then, on the adjusting portion, you will have to compute the unexpired. Because in here, in 11.1, you assume that the whole 5 months have been consumed, where in fact, the 3 months is unconsumed. The 2 months is the only ones consumed, right? So, you have to record the prepaid rent here, which is the unexpired portion, which is 3 months times 5,000. 5,000? Am I right? 3,000. 3 months times 3,000. That is 9,000. And then, you have to deduct the rent expense worth 9,000. Okay? Now, if you summarize, it's still the same. The unexpired at the very beginning is 0. Because on 11.1, you did not recognize prepaid rent. So, the unexpired here is 0. Everything is expired at 15,000. However, because of the adjustment, the prepaid rent has been debited with 9,000. So, in effect, the unexpired became 9,000 at the end of the year. Whereas the expense is 15,000 at the very beginning, but it was deducted, it was credited by 9,000 minus 9,000, it is already 6,000. As you can see, there is the same balance. The unexpired is still 9,000, the expired is still 6,000. Okay? So basically, in substance, they are basically the same. Okay? However, in here, the whole 15,000 advance payment has been recognized immediately as an expense. Okay? That is why this type of recording is what we call as expense method. Why is it used, the expense method? Where in fact we can understand the concept of the asset method. So the expense method is recognized as an alternative for recording advance payments or deferred expenses. It is because sometimes you will incur some expenses. You will pay for expenses in advance, but it will not reach the December 31. Like for example, on January 1, you paid this. January 1. Of course, on 12/31, where the adjustments are normally written, the adjustments are normally recorded for 3 months, for 5 months. So that means January, February, March, April, May. On May 31, there is no, what do you call this? An expired portion already. Everything will be expired by May 31. You understand? So if that will happen, this entry is better because you don't have to make any adjustment at 12/31. Again, let me repeat that. Expense method, is used for efficiency purposes. Okay? So normally, the adjustments are recorded at the end of the year. Okay? For example, this particular advance payment for 5 months happened on January 1. So since it happened in January 1, so it will expire in 5 months. That means January, February, March, April, and May. So on May 31, of course, everything will be expensed already. Right? So if that happens, the expense method is better. It is because you don't have to make any adjustment because literally on May 31 only, the 15,000 was fully expensed. So it's much more efficient. So if you have some advance payments, which you know will expire before the year end, it's better to use expense method. So in this particular case, it's as if they are just the same. It is because the expense, or no, the advance payment happened on November 1. Okay? But if it is on January 1, this entry will suffice. There will be no adjustments. Okay? So let me repeat that. Expense method is used for efficiency purposes, and if you are sure that your advance payment will be consumed, will be expensed before the year end, then use expense method because you will not have any adjustments at year end already because it's fully consumed. Okay? Unlike the asset method, like if it is January 1, then after 5/31, everything has expired. Since you entered on January 1, prepaid rent 15,000 and cash 15,000, of course, at the year end, you are to make an adjusting entry. It is compulsory. Okay? So, those are the two. So, what are the characteristics of asset method? First, on the asset method, the advance payment are recognized as an asset, temporary asset. But later on, it will be expensed as time passes by. Okay? Now, at the adjusting entry, what will be adjusted is the expired portion, the 6,000. That will be the entry, the expired portion, because you have already recognized the unexpired at the very beginning at the original entry. So the focus of the adjusting entry is to record the expired portion. Okay? On the expense method, it's different because it will be treated immediately as an expense upon original entry. So since it is expense, the adjusting entry at year end will focus on the unexpired portion, which is here. It's the 9,000. It's the 3 months rent. This is 2 months rent, the expired. This is 3 months rent, the unexpired. The entry for the adjustment is the unexpired portion when using expense method. Okay? So that's on the deferrals or deferred expense. Okay? So you have to be familiar with that. And of course, I told you, and of course, in order to practice more, actually supplies are also recognized as either asset method or expense method. So in order for you to master, so let's have another one. Let's talk about the supplies. So it is said here that the supplies were purchased for 20,000. 10,000 was paid in advance and the rest were paid after 2 months. So that means there is an original entry. Now, if you are going to recognize this as an asset method, in the asset method, of course, you will debit supplies. How much? It's 20,000. And then you have cash because you have paid a down payment of 10,000. And the rest is accounts payable, if you can still remember what we have talked about. Okay? That's the original entry for the supplies. And upon adjustment, you will have to recognize the expense because you have to enter supplies expense. And according to number 2, the supplies on hand is 3,500. So that means that's the unexpired portion. So meaning, at the very beginning, the unexpired portion is 20,000. And we have the expired ones. we have to work back. It's because what's given here is the unexpired at the end of the year. So unexpired at the end of the year is 3.5. Then that means as if there is 16,500 that were used, that were expensed, that were expired. Okay? So you are going to recognize the expired because again, we are using asset method. So we have supplies expense 16,500 and then we credit supplies or we decrease the supplies by 16,500. So 20,000 minus 16,500, you have the remaining supplies of 3.5. Okay? So that's for asset method for supplies. But if you're going to use expense method and if you are sure that these supplies or consumables will be expired all 100% at the end of the year, then use expense method. That's why this is an alternative. But in here, it's very clear that it has not expired 100% at the end of the year because there is a supplies on hand. So meaning, you have here at the original entry, supplies, expense. So everything is expense outright, 20,000, and then cash, 10,000, and then accounts payable, 10,000. But then again, at the end of the year, your adjustment should focus on the unused or the unexpired, which is again the 3.5, the unused. So you have to debit supplies because basically this 20,000 supplies expense did not really happen. You did not use the full 20,000. So there is 3.5 supplies. It will become an asset and then you have to deduct the supplies expense by 3.5. So it's still the same. The unexpired here is still the 3.5 at the end. The unexpired at the beginning is still 20,000. The expired is still 16,500. Because in here, the supplies expense, 20,000. Supposedly, that is the expired at the very beginning. But in the end, you have deducted supplies expense by 3.5. So the expire is 16.5. They are very much the same substantially. Okay? Now, there are problems that will require you to use expense method, especially if ever you can see in their chart of account supplies expense and there is a value on the supplies expense. However, in the supplies, in the asset, the unused, there is zero. So there are some hints like that. Okay? So if you did understand already the deferred expenses, this is the full lecture for deferred expenses for C and 1 and D and 2. So that's one of the members of the adjustments. Okay? And if it is a deferred expense, there is always an original entry or original transaction and an adjusting transaction at the end. Okay? But then again, I told you, there are two types of deferrals. So, if this is deferred expense, we have deferred revenues. So, let me erase this. So, the deferred revenues are advance payments still, the same with the deferred expenses. Except that, the advance payment in deferred revenues are coming from the customers. Okay? So that's basically here, letter H, here, and this number 6. So that is deferred revenues. So deferred revenues actually, in simple terms, advance payments from customers. Okay. So advance payment from customers, that means they have paid you even if you are not deserving yet. So you're not deserving yet because you have not delivered the goods or services yet. So those are what do we call as deferred revenues. Okay? So what will happen if we have deferred revenues? So even if you have received from 3 clients in letter H cash, actually it's the original entry or original transaction. And this number 6 is the adjusting transaction. Even if in the original transaction you have received from customers 80,000, meaning you have to debit cash 80,000. You cannot claim it as revenues first. Okay? Because again, you don't deserve it. You have not delivered the goods. You have not delivered the services yet. In this case, services. And according to accrual concept, revenues are recognized when earned, regardless of when collected. So even if you collected it in advance, that is not yet a revenue, which is why it's considered as a deferred revenue. Okay? And deferred revenues are liabilities on your part. When you receive cash in advance and you have not done anything yet that you are supposed to do, like services, you have not yet given services or goods, that is a liability. And normally, that is entered as unearned service revenues. So unearned service revenues, again, since it is unearned, it is considered as a liability. Okay? So, that's the original transaction entry. On the adjustment, of course, these particular clients, after 1 month of services, this particular liability that you have will bit by bit be earned by you. Okay? And it is evident here. 1 month of advance payments from clients has already been earned. So that means if 80,000 is for 5 months, that means 80,000 divided by 5. How much is that? 20. I guess it's 20. 80,000 divided by 5. 16. I guess it's 16. 80,000 divided by 5 is 16,000 has already been earned. So what will happen is that this liability, which has been credited, which has been increased, will be deducted or debited. And earned service revenues, 16,000, and you have to recognize already revenues of 16,000. So we have here the unearned portion or the unexpired portion, 80,000. However, there is the earned 16,000. So the unearned ending or the unexpired earned ending is 80,000 minus 16. We have 64,000. Yeah. Yeah, 64,000. Now, this is very much directly related to the accrual concept. It's true that this 80,000 you have received it, but you have to make it a liability because revenues are only recognized when earned. So we're always going back to the accrual concept because the reason why there are deferrals, why there are original transactions and adjustments, it's because of that concept. Okay? Because we're not following cash basis. This is the opposite of cash basis. Okay? Now, this is what do we call as liability method. Why is it considered a liability method? It is because the advance payment from customers are recognized initially as your liability, which is again correlated with the accrual concept. Okay? However, there is a secondary method of recording these advance payments from customers. And we're talking about revenue method. So on the revenue method, you immediately recognize the 80,000 as revenues, even if you are not yet deserving. Why is it? The same reason or similar reason to the deferred expense reason under expense method. Sometimes, you will have an advance payment from the customers on January 1, for example. And then, they have paid for 5 months. So meaning on May 31, it will still be earned at May 31. So no need adjustments in 12/31 or at the end of the year. So sometimes it's much better to use revenue method for those revenues that you are sure that you are going to earn before the year end. Okay? But that is not happening in this particular case, which is why there is an adjustment. So on the revenue method, since you have recognized already the 80,000 advance payment from customers immediately as revenues, you have to find the unearned. So the unearned here is 4 months. So you have to recognize the unearned at the very beginning, which is basically 80,000. The earned, you have recognized immediately as 80,000, but you have to adjust this because the unearned ending should be 64. So if the liability method focuses on the earned portion, the revenue method focuses on the unearned portion, which is the 64. So meaning you have to deduct your service revenues because you did not earn the full 80,000, you only earned the 1 month of it. So service revenues, you have to deduct 64,000. So that's the unearned portion. And then you deduct unearned service, you deduct the service revenues by 64 and you have to establish the unearned service revenues of 64,000. So again, the characteristics of using liability method for advance payments from customers is that the advance payment should first be recognized as unearned service revenues. But as to the adjustment at the year end, the adjustment focuses on the expired or the earned portion, the 16,000 here. Whereas, if you use the revenue method, everything, the cash received from the customers in advance is recognized immediately as revenues, 100%, but at the end, you have to establish the unearned, which is the 64,000. Okay? So those are the adjustments at year end. Two already. I have already discussed the two. We have the deferred expenses or your advance payments and the deferred revenues, which are advance payments of the customers. Okay? However, there are other two. There are other two items or classifications of adjustments. So those are only two. However, this second set are much more simpler. It's easier than these two, deferred revenues and deferred expenses. So we have the accrued expenses, which is the opposite of deferred expenses. The accrued expenses are you are late in paying, late payment. That means you have enjoyed already the benefits, but you did not yet pay. And that is here in the salaries incurred but unpaid. So that's here in number 4. So that's an accrued expense. If you have already enjoyed the benefits of the service or goods, you have incurred it but you have not yet paid, that is what we call as accrued expenses. And when you see accrued expenses, that's a liability. Because again, you have enjoyed already the benefits, but you have not yet paid. So accrued expenses are liabilities. Okay? So there is no original entry and adjusting entry here. Just one entry, the adjusting entry, which is, if we're talking about number 4, you just have to recognize the appropriate expense, salaries, expense, and accrued salaries. Sometimes the companies use the account salaries payable. It depends on their chart of accounts. So that's it for the accrued expenses. Okay, so that's the third item for adjustment. So number 5, we have accrued revenues. This is number 3, right? Number 4 is the accrued revenues. This is the opposite of deferred revenues. Accrued revenues, customer is late in paying. That means you have already delivered the goods or services that you are supposed to deliver, but the customer did not yet pay. And an example of the transaction is this number 5, which is the services, you have already billed the services. And of course, you're not going to bill any client if ever you have not yet uh, delivered your services, of course, you follow, or the goods. You're going to bill if ever you have given what you are supposed to give, services or goods, and they did not pay yet. Okay? So that is an example of accrued revenues. So what will happen is that there will be no original entry and adjusting. It's just one entry. You have to recognize receivables because again, you have already done your part. In here, that's 5,000. And the other one is service revenues. Because again, according to accrual concept, revenues are recognized when earned. And in here, you have already earned it because you have billed the customer already. That means you have delivered your services or goods already. So those are the 4 items of the adjustment. Actually, there are still 2. So the first one is the easier one. It's related to the accounts receivable. Okay? So the 5th is because of the fact that if ever you have an accounts receivable of, for example, 100,000, it's not here. If you have an accounts receivable of 100,000, there is a portion of that balance which is, what do we call this? Doubtful for collection. Okay? Like for example, on 100,000, 20% is doubtful. So you have to make an adjusting entry because of that. Because we are going to follow the conservative principle wherein we have to expect the worst. Okay? So if we're going to expect the worst, that means you're going to assume that all of your 100% accounts receivable will not be collected. There will be a portion that will be doubtful for collection. Okay? So what will happen if we're going to follow my example? What will happen is that you will have bad debts expense. It could be bad debts expense. It could be doubtful accounts expense depending on the chart of accounts of the company. So bad debts expense is 100,000 times 20%. That's 20,000. And then, instead of using accounts receivable, and supposedly, you're going to use accounts receivable so that the 100,000 accounts receivable minus the doubtful of 20,000, we have 80. Right? That is what we call as net realizable value. Okay? So supposedly we're going to use the accounts receivable, but normally it will not be used. The ones that will be used is allowance for doubtful accounts, allowance for doubtful accounts, 20,000. So this is a contra asset account. Actually, when you present the asset AR, you will have to present the full 100,000 and then you have to less the allowance for doubtful accounts, which is in this case 20,000. We have the net realizable value of AR 80. So still it deducts the AR. However, it is the doubtful accounts are, instead of crediting it to AR immediately, in order to preserve the original balance of the AR, we're gonna use the allowance for doubtful accounts. This is always merged with accounts receivable. This is a contra asset account. It is because it deducts the asset, which is the accounts receivable. Okay, so that's the 5th one. And the 6th one, Again, the sixth adjusting entry item is the depreciation. So let me enumerate again. The adjustments that you have to look out for at the end of the year is always number one, the deferred expenses or your advance payments. And number two, your deferred revenues, which are cash advances from customers. Number three, we have the accrued expenses, in which those are the expenses that you have enjoyed but you did not pay, so you are late in payment. And then we have number four, the accrued revenues, wherein the customers are late in paying. So you have already delivered your services, you have already delivered your goods, but they did not yet pay. Number five is the doubtful accounts expense, as discussed here. And number six is the depreciation. Okay? So the depreciation, if you can still remember, in this particular sample problem that we have about BBG company, is all about this office equipment. So it was purchased 30,000, and then the equipment's life is actually 5 years. So that means after 5 years, it will be unusable. However, even if it is unusable after 5 years, it can be sold still for a salvage value of 500. Okay? So, how do we compute for the depreciation? If you can still remember, you start with historical cost, which is 30,000. And of course, you less that one with salvage value, or the minimum amount that you're gonna get if ever the office equipment is unusable already. So that means it will only decrease by 29,500 for 5 years usage, or for its useful life. So that is what we call as depreciable amount, or the maximum potential decrease of value if you use that in full in its useful life. Okay? Now, in order to get the depreciation expense, normally it's per year. So 29,500 divided by 5, we have 5,900. So that's the depreciation expense per year, 5,900 per year. So what does this mean? Meaning, if the office equipment is brand new, its value is 30,000. Okay? However, as time passes by, after 1 year of use, it will be deducted by 5,900. And then second year, minus 5,900 again. And the year 3, minus 5,900 again. In the year 4, minus 5,900 again. And lastly, minus 5,900 in the year 5. And the value will be 500. Okay? And if the value is 500, then you're going to sell it, and then you really realized 500, then you have debit cash 500, and then credit the office equipment if ever. Okay? But then again, in this particular case, since there are only 2 months in the BBG company, because it started in November 1 and it will end in December 31, the period. So that means the 5,900 is not applicable. It's only 2 months over 12 months. So 2 months over 12 months of the 5,900 times 2 divided by 12, we have 983.33. Okay? So, your entry in that one is debit depreciation expense, 983.33. And then, instead of deducting the office equipment, supposedly that's office equipment, right? So that the whole 30,000 will be deducted by the 983.33 in order to reflect its current value or book value. However, we're not going to use the office equipment. We will use a contra asset, which is what we call as accumulated depreciation dash office equipment. So 983.33. But don't worry, because the office equipment will have 30,000 at the end. However, there will be a less accumulated depreciation, 983.33. It will still be deducted because this accumulated depreciation is the same with the allowance for doubtful accounts. They are considered as contra assets. So, the book value of the office equipment will still be adjusted minus 983.33. So, 29,016.67. And that's it for the adjustments. So, there are two things that I'd like to say before we end this particular video. The first one is that, again, these adjustments, there are 6 types of adjustments that you have to watch out for at year end. The first one are the adjustments for the deferred expenses, the deferred revenues. Again, deferred expenses are your advance payments to things that you have not yet consumed, or you have not yet consumed the benefit. And we have the deferred revenues, which are advance payments from customers wherein you do not deserve it yet because you did not yet deliver the goods or services that you are supposed to deliver. The third one are the accrued expenses, which is the opposite of the deferred expenses. And under the accrued expenses, you have already used the benefit. You have already consumed the benefit. You have already incurred such expense, but you did not yet pay. Okay? And we have number 4, the accrued revenues, wherein the customers have already used the benefit from you. You have already given your services. You have already given the goods that you are supposed to give, but they did not yet pay. That's accrued revenues. The fifth is the doubtful accounts, the adjustment for doubtful accounts. And the sixth is the depreciation. Okay? So that's the summary. The second that I have to emphasize before we go further is that these adjusting entries, this adjustment for accrued expenses, adjustment for, what do you call this? Adjustment for accrued revenues, depreciation, bad debts, and these adjusting entries for the deferred revenues. Here, let's focus here. And the adjusting entries for the deferred expenses that I had erased already, the adjustments only. Those will be used in the preparing of the worksheet, which is in step 5 and in step 7. So the adjustments, those 6, the adjusting entries for deferred expenses, deferred revenues, all those 6 will just be used in the step 5, the preparation of worksheet, and step 7, which is adjusting journal entries are journalized and posted. Okay? So we are still on step 2. Okay? So that means these original transactions, the entries for that one, as well as the others, those are the ones that we are going to talk about in the next episode as we go to step 3. So again, the adjusting entries for the 6 that I have mentioned will still be on step 5 and step 7. But then again, I have to let you know about this already as early as now, because I think the journal entries as well as the adjusting journal entries are the most difficult part in these fundamentals of accounting subject. Okay? So thank you for watching, thank you for listening, and see you on the next one.